What's up, everybody, and welcome back to the bootcamp. Today is episode 8 of this bootcamp, and we are going to be discussing liquidity part 2. We already went over what liquidity is, but today we are getting into the full in-depth breakdown of how to use liquidity, where it lies, the best liquidity versus the worst liquidity, all of that fun stuff. That being said, we all know my model and most models these days revolve around liquidity and draws on liquidity and how to use it. So this is a very important video. This is going to be a bit longer, so make sure you pay close attention, take some notes, and try to pick up as much as you can. Before I get into this video, I just want to remind you, liquidity is what sends price in a specific direction. So you have to think this liquidity is necessary for the market to move. The market needs to fill these orders to send price in a direction, whether it be higher or lower or sideways. It needs orders to send it anywhere. So these orders are going to be hunted. They have to be filled for the market to exist. They have to be. There's no choice. So that's why people say liquidity's swept, liquidity's hunted, because this is necessary for our markets to move in the ways that they do. So just consider all of this, and consider when there's orders and there's areas of price that are at highs or lows or data pools or whatever we may talk about. These are necessary and they're going to get hit. They need to get hit in order for this to work. So just keep that in your mind while we go through this video. One more thing, free PDF in my Discord. Download it. It's all the liquidity pools ranked from best to worst, where liquidity lies in a written format. Keep that next to you, print it out as you go along through this video. Look at the sheet, watch it, and test it for yourself. All right, so starting us off, we are going to have session liquidity. Session liquidity is probably the easiest liquidity pool to understand, but it is one of, if not the most important liquidity pool. And why it is so important is because you have 3 different trading sessions. You have Asia session, London session, and New York session. And what this means is in Asia session, that is when the banks in the Asian countries are open and are trading. So when they are trading in their specific time frame, all of their orders that are liquidity are being filled and are being left at the highs and lows and within that range of their session. And then you move into London session, and the same thing. The London banks are trading, leaving all of their liquidity. And the New York banks are trading, leaving all of their liquidity. So what this does is this leaves a massive amount of orders resting in certain places because it is all the orders from their session left in one area. So when you take a liquidity pool from a certain trading session, you're going to expect to get massive reactions or reversals off of these liquidity pools because there's that many orders resting in that area. So for example, I drew out this little chart here, and what we have is in this blue box, this is Asian session. So if we had Asian session highs and Asian session lows, why are these going to be important? Well, at Asia session lows, we know we have a ridiculous amount of orders because this is the lowest point that an entire trading session reached. So all of these resting orders are going to be resting underneath these lows because all of those sell stops and those buy stops or whatever it may be, those orders at the high or low are going to be resting there because that's an entire country's economical orders in one little area of price. So in Asia session, if we leave a low here, we have Asia session lows, which is marked out by our indicator, which we already went over in a previous video. So let's say we open up a London session and we take Asian session lows. Well, we just filled all of those orders and that ridiculous amount of orders waiting to send price in the opposite direction. So you oftentimes see off of these session liquidity pools a major reaction. Then London took that low, reacted, made a major reaction up to the highs, took the highs, then had a major reaction lower. And then once again, you are leaving highs and lows coming out of London session, and then you will start your whole new trading session, which would be New York trading session. So it's important to realize that if you're heading into New York session, that you can now worry about London session highs and lows. And sometimes you even leave Asia session highs and lows too. But if we're going to come for a London session liquidity pool, you can expect an even greater reaction off of those lows or those highs because there's so many orders there. So sessions are really big when it comes to orders. All right, now let's try to apply this on the charts. So right here, we open up Asia session and we trade and we have Asia highs, we have Asia lows. All this gets formed and we have our Asia highs and Asia lows. Right here, our session liquidity. So we'll see if I let price play out. Move in throughout the overnight session, and then we hit London session. London opens up and takes Asia highs. What can we expect from these highs is a massive reaction to the downside because we just took an entire session's liquidity pool at their high. We took this whole high out with all those sessions orders. We can expect a big reaction to the downside because we filled all of those orders, and there's nothing else stopping price from going lower. So we fill these orders, hit that, and then you can see throughout London session, we trade lower and hit Asia session lows. But now we have to let London session play out. And what you'll see happen is London session finishes, but because we took Asia session lows, We had nothing else stopping us. We went higher because we filled all these orders at the low. You can only expect a massive reaction to the upside now. Fill the highs, go lower. Fill the lows, go higher. Large amounts of orders mean large amounts of volume coming into the market, meaning big moves. And that's what we try to capitalize on using these session liquidities. And I'm sure if I let New York session open up, let's see what happens. New York session opens, we trade London highs. Trade to the highs, get a massive reaction lower. And we even see after we take London lows, we start to react to the upside. It's just session liquidity. It's a bunch of orders resting in a small area of price, means big movement in the market. Now, let's start thinking through this a bit more. So you know your session liquidity, but you can't just rely on these simple highs and lows to determine where you think price might go from high to low to high, like ping pong. It doesn't really work like that. So now what I want you to start doing is start thinking through various confluences that you've learned in the past. You can combine market structure with session liquidity, and now you can see, okay, we're in an uptrend, but we just took Asia session lows, but we're still holding this uptrend. We're inside of a fair value gap, which we're reacting out of. We might start to trade higher. It's just a matter of combining these things to get that high time frame analysis, which you already know how to do. Moving on from sessions, I want to talk a bit about low resistance liquidity and what that actually means. So we know if a high time frame session liquidity pool gets swept out and it sends price in the opposite direction, we know that that move was sponsored or sent by that session's pool's liquidity. So let's say, for example, on charts, we took Asia session highs, and then you saw throughout the rest of whatever session we're in, we start trading lower until we take Asia session lows. But on the way down, we made all of these stacked up highs. So if we were in a clear downtrend, we have stacked high, stacked high, stacked high, just all of these highs on the way down. But then we sweep an entire session liquidity pool, such as Asia lows. Now, what you can expect now is all of these highs to get ran back through. You can expect us to continue higher off of those lows to the highs. Why, you might ask? Well, that's because what is stopping us from going higher? Nothing, because we took the major sessions liquidity pool, which was above, and then we started trading higher off of the session's lows. There's nothing resisting or stopping us from running back through these highs. So if you see a bunch of stacked up highs or lows, maybe 3 or more sets of highs with nothing in between that's going to stop them, like a session pool's liquidity or a high time frame fair value gap, as soon as you hit the next big liquidity pool that's going to have a lot of orders there, which you can only expect those are going to get ran through because there's nothing that's going to stop you. Now, moving on, let's talk about high resistance liquidity. So there's a big difference in these types of liquidity. So let's say we continue this drawing. You took Asia lows, you see a little bit of reaction off of it, and you sweep some sort of high, like this random high right here in the middle of the range. Do you think this low is a good target? You might be thinking yes, because you just swept a high. Now you're seeing market structure kind of shift to the downside towards this low. But what you're failing to realize is in this area of price, we just filled a ton of orders. Orders have been filled. We sent price higher. But what is going to send price back to this low would be more orders filled. But if you're considering you just filled hundreds of thousands of orders down here, why would we target this low? Because this low swept a liquidity pool. So if we swept a major liquidity pool and put in this low, you can only imagine there's a bunch of orders that are being filled, sending price higher. Why would we target this low again? It already did its job. This served its purpose. It filled orders. You can only imagine we're going to hit the next draw higher. You don't want to be using this as a target to go lower because there's all those high resistance orders there. And you're not going to expect this to get hit because we should just continue through these highs because there's nothing at these highs. There's not many orders sending us lower until the next high time frame gap or session liquidity pool, whatever. Doesn't matter. You have to consider these orders have a job, and their job is to either put resistance so you're not going to go back to a certain area of price or send price to a different direction. You don't have to worry about that until that next area of price gets hit. So you have to consider what could stop us from getting to a certain area or what should send us to a certain area. You have to think of it like I always say, it's telling a story. What's going to be low resistance? What's going to be high resistance? Let's talk about a few more area prices that are super important. So one that comes to mind is equal highs and equal lows. These are super important areas and highs to be aware of because, for example, on the charts here, let's say we're in a little uptrend, we make a high, and then we trade a little bit lower, we come back up, and we trade right to this high again. But we don't sweep the high because we know in order for liquidity to be useful and to get filled, you have to sweep a high. Well, we don't see this high get swept. We see us make a perfect equal high at this high. This should tell you something. Orders are meant to send price in a direction, but they have to be swept first. So if we make a perfect equal high at this high, what we now have is two sets of highs at the exact same price. this is going to get traded back to because we now have two highs. We have two highs. A high is an area of liquidity that you look to get swept and you look for a reaction off of. Now we have another high there. If we have two of the highs in the exact same price, that's two confluences that we're going to go lower at the exact same price level, equal highs, meaning more than likely these highs are going to get traded back to because that much more liquidity lies there. You can expect these highs to get traded back to. Same thing would go for the lows. Let's say we made a perfect equal low at this low right here, started trading a bit higher, but you notice we have equal lows right here, or relative equal lows that are almost at the same price. These are probably going to get traded back to. Why wouldn't they? Because you now have two confluences, two areas of liquidity that should get hit. Why should they get hit? Because the market seeks out liquidity. We need these orders for the price to move. Liquidity is always going to be hunted. You need these to get hit to keep the market moving. Next on the list is going to be data liquidity. This is another massively important liquidity pool. An example of data liquidity would be news data comes out at a specific day at a specific time. At, let's say, 8:30 a.m., CPI news comes out, and we see a massive reaction in the market. You know this because you check Forex Factory or any other preferred news tracking website that you use to see what news is important to you. So if you trade the NASDAQ like I do, all USD news is going to be important to you, and it's going to be specifically the red folder news that matters to you. And you can see this by going over to the little filters here and selecting the red folder versus the orange folder or the yellow folder. You can see there's a bunch of different news events that you can pick from. The only real important ones that you have to worry about are going to be red folder news. So if I filter it down to just red folder news, you'll see these are only the news events that matter. So we have some news on Tuesday, we have some news on Wednesday, and we have some news on Thursday. But we're only worried about the USD news because we only trade US indexes. We don't trade whatever the hell the other indexes are. We're not worried about those. And what you'll see is on the charts, you'll see a news candle come out when these events release at the specific time. So let me pull up the charts and show you an example. So when this news releases, this clearly has a lot of impact on the market. So what you'll have is just a ginormous candle come out at 8:30 a.m. or 10 a.m. or whenever the news comes out. You'll just see a massive candle get printed. And this candle is super important because you'll put in, at the top of this candle, you'll get what's called a data high. And at the bottom of this candle, you'll get what's called a data low. So if you get your data lows and your data highs that get put in, you know this is going to matter to you because tons of orders came out at the specific time. So if tons of orders came out at the specific time because a news event happened that sent either the market up or the market down, just a bunch of people, because of this news-related event, bought or sold whatever index you're trading. So there's going to be a ridiculous amount of orders at the top and at the bottom of this candle because so many orders were just filled at the specific second of price. So what you'll commonly see is if data news comes out, you'll see this news react and you can maybe trade. You'll take the high of this candle. There's going to be a bunch of orders up there because like I said, people were panic buying and selling at this time. You can only expect we're going to trade lower, probably to the data lows or vice versa, lows to highs. You get the gist. Once again, an example on the charts of this happening in real time would be, you have 8:30 a.m. high impact CPI news on this Tuesday that it was. So let's see. If I let price play out, you'll see specifically at 8:30 a.m., which is going to be the next candle, you get a massive candle that gets put in. Just massive out of place candle. It doesn't even look right. So the high and the low of this candle is going to be super important. So if we took the very top of the wick and the very bottom of the wick of this candle, you can see after this news comes out, we take the candle's high. That's your data high right here. So if we take the data high, you can only expect we'll probably take the data low because we just filled that ridiculous amount of orders at this high. You can probably trade to the low because there's another pool of just resting massive amounts of orders. So let's see. We trade through the high, get a reaction, start trading down, you take the lows. Data highs and lows, super big, super important. Tons of orders that happen in a split second. Last thing I want to talk about is internal liquidity and specifically unfilled fair value gaps. And these are super important to the way I trade because it's within like a certain area of price, like 15 to 30 minutes. You can find little liquidity pools in the legs that we're making in live action. And you can use these when you're trading in live time because obviously you're not trading just session to session. You're trading within a 30 to hour long window. So the type of liquidity that I found best is 5 and 15 minute unfilled fair value gaps. And that means fair value gaps that haven't been traded to ever before, like a fresh fair value gap we'll talk, an untouched, an uncracked fair value gap. No one cracked this thing before. So the reason this is important because there's tons of resting orders because these are normally made after a liquidity pool gets hit. And this is good to catch continuations off of or to use as your condition for if we might reverse. And this helps you because you're not going to take a trade immediately off a session liquidity sweep. You're going to need a little bit of continuation liquidity to work with. So I made a little drawing here. price moves like this. It doesn't move like this. So you're not going to see liquidity get hit, then just reaction. You're not going to see that. You're going to see us come up, come down, come up, come down. Just make this like little choppy movement. You don't, price chart doesn't just look like diagonal directions. It looks like that for a specific reason. That's because there's orders in all of these areas of price. There's tons of orders that are being sought out, even on the lower time frame, rather than just high time frame session liquidity orders or data orders. Liquidity lies everywhere, and you need to know that on the lower time frame. That was probably tough to understand just from me explaining it, but it's so much easier when you see it. So a good example I found was this trading session. So New York market opens and we sweep a low, and then we trade right to the pre-market highs. You couldn't have taken a trade in here, but you'll see throughout the session, we sweep a high, and then we start to move lower. And what we made on this way down was this unfilled 5-minute fair value gap. So if we have this unfilled gap, we know a bunch of orders rest here because it's never been tapped before. It's never been cracked. No one's ever touched this fair value gap. So you can expect this to get traded back to, because within a little session, we have our little leg, but we have this gap, which is going to be super important to us because there's tons of orders in there, because this high was swept, sponsoring the move lower. But we know this gap has orders that are being sent in live time in this direction. So you'll see later on through this trading day, we trade back into this gap because there's these tons of orders there. These orders are getting sought out, and you can see we continue lower off of this gap because it's been had orders there which have sent price. So these orders get sought out. We always want to take orders no matter what's happening. So you can see liquidity sweep, session liquidity sweep, gap fill, continuation. Same thing. We even made another new gap off of that gap fill, which was traded back into and continued off of. All right, that was all I had for liquidity, and I know that was a lot, but all of these are super important, and you will see them on a daily basis. I encourage you, go onto the charts, back test this, just get your reps in, find liquidity, find high impact news, look at when high impact news was and see how it played out. Find the data wicks, mark out your session highs and lows, mark out your unfilled fair value gaps. Do all of this. Mark out your low resistance liquidity. After we swept a high, watch the little highs that we made on the way down get filled or get swept out. See what has resistance. See what doesn't has resistance. The only way you're going to get better at this is if you back tested. So you need to start going back on the charts, looking back in previous time, and finding out what works and just seeing it for yourself. Once you see it, it'll all come super easier. That being said, free live trading every day. My model's broken down in my Discord. Join that, and I will catch you all in the next bootcamp video.